management in the past. First, these risks are taken, the banks go under, they're handed over to the National Deposit Insurance Corporation, the NDIC, and they're called failed banks. And then the depositors lose their money, they get paid a small amount, insured deposits, the directors and the management go ahead, there's some bad news, then they go and build their houses abroad, and they come back later and they become senators, and they become governors, and they become ministers, and they are captains of industry. And everybody lives happily thereafter. What we said in 2008 and 2009 was banks won't fail. They're killed. And we were going to save the banks, and we're going to find the people who killed the banks. So the first thing was to take action. And for each of those 8 banks, we removed the chief executive officers and the executive directors and replaced them with management appointed by the central bank. We then injected enough money in those banks to make sure that they kept afloat while we figured out how to recapitalize those banks. But then, having stepped into the banks, we then discovered that the problem was not really, in most cases, a simple case of bad credit decisions or bad risk management. That in fact some of those numbers did not represent loans, but money stolen out of the banks. That people had set up SPVs, and the lenders and the borrowers were the same people. And in some cases, the loans had actually been taken to buy property outside the country. In one case, we recovered 200 pieces of real estate in Dubai. And that's how bad it was. Plus property in South Africa, property on the Portugal. SPVs had been set up, money had been taken out, and it had been going on for years. So the crisis for us afforded us an opportunity to see things that nobody had known were happening. As they say, when the tide goes down, you then know who's been swimming naked. And so it became not just a case of regulatory, of risk management and bad credit decisions, but certainly a criminal activity. We have so far jailed one CEO. I think we're likely to jail 2 more very soon, if it's in trial. And I did believe very strongly that the kinds of things that happened were things that would continue happening until people realized that there were certain lines that they could not cross. And that banks are first and foremost institutions that are entrusted with the safety of customer deposits. And yes, you can make money, but you cannot make money by taking careless risks. And now, having done this, we had to fix major issues of corporate governance. And some of the steps we took are steps that are being debated now in Europe. I think I've seen reports where some are being contemplated for introduction in the UK from 2019 or 2015. We have, for example, broken up universal banks. No bank in Nigeria can own a subsidiary that is in non-banking business. So if you're a commercial bank, you're supposed to sign commercial banking. And if you want to do merchant banking, you acquire a different merchant banking license. They can have holding companies that can own commercial banks and asset management corporations, but we've now introduced very strict rules that ensure transparency and arm's length relationships between 2 companies in one holdco. But the interesting thing was when we issued the new guidelines and gave the banks the option of remaining universal banks or commercial banks, 21 out of the 24 banks, initially 20 out of 24, now 21 out of 24 opted to sell the subsidiaries. Because once it became clear that depositors' funds could no longer be used for those businesses, it became suddenly unprofitable. And the models have changed. So without necessarily forcing anyone to get out of the business, all Nigerian banks basically decided to exit asset management, real estate, and all sorts of booking offices that were used, that were basically avenues for what we call deposit to private equity conversion, and deposit equity swaps. So a bank would have what is called an investment banking subsidiary and place money with that subsidiary as a placement, and then that subsidiary would take that money and invest as private equity. But it was a loan, and when something happened to that investment, it hit the depositors' funds that were so rich. So now we've got rules around that, we've got limits around that, we've got transparency guidelines, and I think they just looked at them and said, well, look, it's not worth it. And so we've got these commercial banks. The other thing we've done is to impose certain changes in corporate governance. Now, some of them are very controversial. For example, we forced every bank CEO who had been in office for 10 years to leave. And not just leave, but to stay completely away from the bank for 3 years. We also asked every non-executive director who had been sitting on the board of the bank for 12 years to leave. And we therefore created a new pool of CEOs and created opportunities for changing some of the old ways of doing things, because there was a strong correlation between CEOs who had stayed there forever. In many of those banks, we had CEOs that had been there for 20 years, 22 years. The so-called executive directors had started as very junior officers. And so when they said to their colleagues, jump, they say, how high? And it was important to make sure that nobody stayed long enough to so compromise the system and so dominant that the auditor, the risk manager, the colleagues on the executive board were unable to stand up to the CEO and ensure that things were done, including the board, because in most cases where a CEO has sat for more than 10 years, the CEO directly or indirectly controlled the bank. Now, they never disclosed. No CEO ever said he owned 5% or 10% of the bank. But it was very clear that they were appointed directors. So we had cases where boards would reject a request, and the CEO would turn around and approve and disburse. So